My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends? I'm just trying to make you some money. My job is not just to entertain you, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. I love the English language, except when it's being abused by Wall Street sharpies who want to throw you up the scent by making the market seem totally incomprehensible. So after a roller coaster day where the averages initially got hammered before rebounding, Dow only gaining 16 points, S&P advancing 0.13%, Nasdaq finishing only down 0.50%. Boy, was it ugly at one point. Let's do some translating. I want you to consider this your Wall Street to English dictionary for understanding the year 2021. First confusing term? Oh, if I have to hear this term, reflation. Reflation is just a regular old inflation after a prolonged period without inflation. When you hear reflation, it means we're now getting higher prices for all sorts of commodities, foodstuffs, lumber, polyethylene, copper, linerboard, the kind of stuff that goes up when there's strong demand for basic goods. Throw in oil for good measure, okay? When you see this kind of pickup in demand, the hedge fund playbook says you need to sell the highest growth stocks and buy the cyclical stocks that do better in a rapidly expanding economy, meaning all the stuff that's seeing price increases. That's what these people mean by reflation trade. The thing is that trade means the broader market's going lower because the big growth stocks get broomed, and in come the classic smokestack stocks, of which we have like a dozen in this country, Caterpillar, Deere, Nucor, and 9 other guys. The growth stocks make up a larger percentage of the averages, though, which is why they were down big this morning, before Fed Chief Jay Powell made some encouraging comments that allowed us to rebound. Powell pretty much said he won't lift a finger to stop inflation until the economy's at full employment. The Fed's not just your friend, it's your best friend. Forever. BFF. Fed BFF. Now, one of the tricks of the reflation trade is that steady Eddie growth stocks get purged. These names do well in a static, low inflation environment because there's not much competition, but they're less attractive during expansion when you've got all these other companies that can raise prices thanks to surging demand. All right, so let's take Apple. You guys know Apple?
Yeah.
All right, okay. Apple, that's a stock that lots of people are giving up on right now. Oh, boy, they hate it. It's like really scary, right? Apple won't charge more for phones or computers or AirPods in this environment. They don't just say, wow, lumber's going up, let's charge more. No, they'll keep consistently doing what they always do. They actually like their customers and they want them happy. Now let's look at them from the opposite direction. What do you think happens at the hotel industry when we're all vaccinated and America's open for business? Will we pay the same price for hotel rooms? Will we pay the same price for airline tickets? Theme parks? Of course not. So for stocks like Marriott, Disney, or Southwest Air, you're going to have to expect a chorus of estimate boosts. And when the earnings estimates go higher, well, guess what happens? That's the single biggest reason why a stock goes higher. Something like Apple may end up selling more product than we thought, but Marriott will sell more product at higher prices. Southwest can double the number of passengers flying from Houston to Chicago. The cost to them is the same. So every additional dollar flows to the bottom line, and that's called operating leverage. Making more money off the same costs. And the companies that have it are golden. The ones without it, Wall Street don't like them right now. Let's go a step further. We value stocks based on their future earning streams. When there's inflation, those future earning streams are worth less because inflation erodes the value of money. If that cash is worth less in the future, okay, then your stocks are worth less right now, especially the growth stocks that are all about doing big numbers many years down the road. That's strike 2 against growth. Who gets hit the hardest? The ones that have no earnings, only sales, because they're even more expensive. They're fine when the economy's stagnant, but that's no longer the case. So these dream stocks like the SPACs, they drift lower. You see how ugly they were today? Well, some of that was because of Churchill Capital, the SPAC merging with Lucid Motors. That was down 38%. Lucid wants to out-Tesla, but the stock got way ahead of itself, and the prospect of heightened inflation means that their future revenue streams are suddenly a lot less enticing, and everyone looked Churchill, and they just gave everything a big haircut, okay? All those stocks. Now, the full beatdown this morning didn't last as the market rebounded in the afternoon because Powell threw water on the reflation trade. And because many of the great growth stocks of this era had fallen double digits from their highs, something that on Mad Money we say you gotta buy. That's what we did for Action Alerts. But I think the morning, not the afternoon, did give us a preview of what the world could look like if the reopening trade means that everybody gets vaccinated and we all go out at once and spend money. What can you do about it? We have a rule in my house. I'm not allowed to tell my wife to relax. Because relax means don't take any action. She says, don't ever tell me to relax. Don't you ever tell me to relax. I said, okay. Whatever's making you miserable, don't relax. So I'm not going to tell you to relax. Instead, let's explain how this plays out by introducing another item. Inflation scare. People love this stuff. They always say, I think we're having an inflation scare. Or, you know what, the reflation trade. Historically, when you get an inflation scare, the presumption is that the Federal Reserve will fight back by raising interest rates. It's been true my whole career. The current inflation scare matches up with the one we saw from November 2015 through February 2016. That's when our last Fed chair, Janet Yellen, decided to raise interest rates for the first time in 9 years. It was devastating for the growth stocks, and the ones that I looked at today were Salesforce, Adobe, Workday, ServiceNow, Apple, Netflix, Amazon, a couple of others. They first got hit when she started talking about the need for a rate hike, because things were getting better. Then they got hit again when the Fed tightened that December. Then the whole group got obliterated in early February after LinkedIn and Tableau data gave us a pair of surprisingly bleak forecasts on the same day, causing their stocks to get cut in half. It was a dark day. We were in San Francisco at the time, and I wasn't having any fun at all. Many investors thought that this was the beginning of the end for those the formerly high-flying stocks. You could hear it. I mean, everybody was saying, this is it. It's starting. Oh, in reality, that was the exact bottom. After the rate hike, the inflation scare died down. Oil prices plummeted. Other commodities cascaded. And you got a chance to buy some of the greatest growth stocks of our era at ridiculously low prices on the day when people said they're finally starting to roll over. They've been rolling over for months. Of course, this time our Fed chief has vowed to hold off on raising rates. Too many unemployed. But there will come a time and a point where these growth stocks will be somewhat hopeless. They'll kind of look like they did today at, say, 947 before people came in to buy. And, Cathie Wood. I have not mentioned Cathie Wood. I just thought I should mention Cathie Wood. One last term, risk off. This is the height of Wall Street can't. Can't meaning jargon, not can't as in the philosopher. If that sounds like a pointlessly confusing choice of words, risk off is the same thing. It just means rates are going higher because business is better, so you don't want to own as much stock. Now, I'm happy to entertain the idea that you need to ring the register here, but I happen to like growth stocks in a reflation scare. I like growth stocks when risk is on. I like growth stocks when risk is off. I would like them in a house. I would like them with a mouse. But Dr. Seuss enthusiasts all, if you want to hold on to the growth stocks and be like the Cathie Wood, and I don't mean to make she's like the greatest investor of our time, I know that. But if you like me and like her and you like growth, you have to be prepared to take some pain. Just like in late 2015, early 2016, that was the last great moment to buy these kinds of stocks. Now, you can just do some selling if you want to and try to swap back at a lower level. I've never really been able to do that well. Just remember, millions of people have lost their jobs. And Jay Powell, Federal Reserve, BFF, let the inflation roll until these people find work. That's him. Does it matter? Of course it does. Janet Yellen threw gasoline on the inflation scare fire in December 2015. Powell has told you he won't do that. He just reiterated that point again today. He's not going to take it back tomorrow. To me, that means we don't have a deep sell-off because this nonsense is just gibberish. The bottom line, after today's late afternoon rebound, it's not too late to sell the more egregiously expensive stocks if you want to, what I call the electric Kool-Aid battery acid plays. But as for the better growth stocks, down more than 10% from the highs, call me a buyer. Not all at once, not big, but a buyer nonetheless into any retest of that 947 low that we saw today.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.